and welcome to the latest Expert Series webinar. Today's webinar is a better way to get commodity market exposure. This is a complimentary IndexUniverse webinar, courtesy of Bloomberg Indexes, UBS Securities, and VanEck Global. I'm Ollie Ludwig, the managing editor of IndexUniverse.com, the public face of IndexUniverse LLC, the leading authority on news and data about ETFs, and we're also the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, I'd like everyone to know that they can ask questions at any time during the webinar in the window at the lower right of your screens, and that the presentation will be available to all of you 24 to 48 hours following today's webinar. Joining me today are Alan Campbell of Bloomberg Indexes, John Kowalik of UBS Securities, and Roland Morris Jr. of VanEck Global. Alan Campbell is the Bloomberg Indexes product manager. His focus this year is to grow the fixed income, commodity, and currency index business at Bloomberg Indexes. John Kowalik is an executive director at UBS Investment Bank in the Commodities Investor Group. He specializes in developing commodity investment solutions for clients including institutional investors as well as commodities-focused asset managers. Roland Morris Jr. is a managing director of commodities strategy at VanEck Global. He focuses on macro strategies, commodities trading, and client development for VanEck's long-only strategies and alternative investments. Now, Bloomberg is a relative newcomer in the world of indexers, and we'll hear a bit about that today. And we'll also hear about products from both UBS and VanEck. Among the 35 ETNs UBS markets in the United States under the eTrax brand name, 9 are commodities-focused strategies that use indexes in the Constant Maturity Commodities Index family, developed by UBS and published by Bloomberg. The biggest among those is the eTrax CMCI Total Return ETN. That security trades on the New York Stock Exchange under the symbol UCI. Additionally, VanEck Global markets the CM Commodity Index Fund. It's a mutual fund. It trades under the symbol CMCAX, and it uses the UBS Bloomberg Constant Maturity Commodity Index as well. So we have a lot to talk about. In excess of $10 billion is now invested in futures-based commodity strategies, and the ETF and ETN wrappers have opened this pocket of the investment world in ways that were just about unimaginable 15 years ago. Now, much of that investor interest stems from the scholarship of 2 Yale professors, Geert Rouwenhorst and Gary Gorton. In 2005, those 2 scholars published Facts and Fantasies about Commodity Futures. In that paper, Gorton and Rouwenhorst created an equally weighted index of commodity futures and studied its performance from July 1959 through December 2004. They found that commodity futures delivered similar returns to equities, but were negatively correlated with both stock and bond returns. Now, even though commodities indexes existed at the time they published the paper, there's no doubt that their findings were extremely important to legitimizing futures-based investing. Of course, the devil is in the details, and maintaining exposures to futures-based commodities can be complex and costly. Whether the issue is controlling contango, picking the right commodities, and picking the right contracts to own on the futures curve, the name of the game in recent years has been to focus on ways to optimize the futures-based investing experience. And the UBS Bloomberg Constant Maturity Commodity Indexes are very much in that category. So, with these broad brushstrokes and specific securities in mind, it's my pleasure to introduce to you Alan Campbell, the product manager of Bloomberg Indexes. Alan?
Thank you, Ollie. I hope all of you can hear me okay. I guess hearing me is one thing, understanding the Scottish accent is quite another, but just try your best, folks. The English have been trying to understand us for hundreds of years. Okay, I'm going to spend 10 minutes discussing the challenges that investors face with traditional commodity indexes. But first up, some very big news, a big announcement in the index space. Last week, we launched the Bloomberg Index business. Let me tell you what the Bloomberg Index business is. It's a new business which focuses on fixed income, currency, and commodity indexes. Issuers of ETFs and mutual funds will license our indexes to create investable products for your clients. We have a long-standing partnership with UBS in the commodity index space, which we'll talk about in detail over the course of the webinar. But you may be interested to hear that last week, Bloomberg launched the first truly global, truly independent fixed income index family. Independence matters, especially when it comes to less traded markets, and we've brought a new concept to the bond markets, independent benchmarks. We think it matters a lot in the post-financial crisis, post-LIBOR scandal environment. Together with some ETF partners, we'll be bringing some ETFs to market in the coming months in the currency space and smarter beta fixed income space. So look out for that and check out BloombergIndexes.com that you see on the slide here. Okay, let's get back to commodities. Apologies to those who are well versed with the commodities markets, but I wanted to start with an introductory slide that shows the concept of time diversification. Given the term structure of commodity futures markets, unlike stock and bond markets where at a given time you have a single point of entry based on a single price, the term structure of commodities offers multiple entry points at different prices. The question is, do you make a bet and pick a point on the curve or seek to diversify your time exposure? Traditional commodity indexes like GSCI have several characteristics that are often cited as concern from investors. Diversification in its many forms is an issue. A much quoted concern is sector diversification. In GSCI, the energy sector weight approaches 70% of the index. That said, both traditional as well as the so-called optimum yield indexes, such as those you see in the Deutsche Bank index, which underlies the exchange-traded fund DBC, suffer from lack of time diversification. What does that mean? For a given commodity, these indexes invest in only a single futures contract. Where traditional indexes roll to the front month contract, the optimum yield indexes roll to a point in the futures curve picked by an algorithm. There are obviously a few problems with this. First, if you pick the wrong point in the curve. Secondly, because you're rolling your entire position once a month into a single contract at a pre-announced schedule, arbitrators can trade ahead of it, potentially to your detriment. In 2007, UBS and Bloomberg joined forces to introduce a novel concept in commodity indexing to solve many of the investor concerns with these traditional indexes. The UBS Bloomberg CMCI takes an approach which can be termed across the curve strategy. In other words, time diversification. A constant weighting scheme is applied across commodities so that a fixed weight in corn, a fixed weight in coffee, but the position is spread across several contract expirations. Positions are adjusted daily, so there's no big bang monthly rebalancing. Okay, so as investors have begun to allocate a portion of their portfolio to commodities in the past few years, there's been a plethora of indexes developed. Different indexes have different components, weights, other rules, which render them very different from one another in terms of historical performance. Let's try to put these indexes in perspective. Broadly, there are two groups of indexes. First, there are those indexes that pick a point in the curve. It could be just the front of the curve or pick a point that's based on an algorithm. Secondly, there's indexes that offer exposure across the term structure. These are time diversified and tend to be less volatile. Commodity ETPs command 6% of total assets of the exchange-traded product market, which is probably in line with what you see as an average allocation in portfolio to commodities. CMCI exposure is available via an open-end mutual fund, as we've spoken about before, by VanEck, sponsored by VanEck, and a family of ETNs sponsored by UBS. In addition to the composite indexes, FUD is the food commodities product in the market, which could be interesting given trends we see in the global food market and the evolution of food habits in emerging markets. I'm going to hand it over now, but please feel free to send us an email or go to BloombergIndexes.com for more information.
Alan, thank you very much. This is Roland Morris at VanEck. And I'd like to start with a couple of things and some basics on why commodities investment might be an appropriate thing for investors and the current state of the commodities market and the outlook. This page here is simply discussing some of the basic reasons that you may want to have a commodity investment. And when I look at the current state of affairs in the commodity markets, unfortunately I have to admit that in the near term, the outlook remains fairly uncertain. And there may indeed, in the very near term, be some more downside risk. But longer term at Van Eck, we believe strongly in the long-term, I wouldn't call it bull market, but I don't particularly like the term super cycle. But the commodities markets, we believe, will offer a very important diversification for investors over the long term. We believe strongly in the continued growth of emerging markets. We believe in rising living standards. And as those markets develop, the demographics there are just so much more compelling than the developed world, and their growth rates are so much higher, that we feel this will drive demand for commodities for many years to come. Currently, post-crisis, if you look back at the last two cycles in commodities, the first one in 09 and 10, post-crisis, was really driven by the dramatic infrastructure spend program implemented by China. That actually created some problems within the commodity markets. It created some overinvestment problems, particularly in industrial metals. And then the down cycle, which really started in the second quarter of 11, was primarily driven by moderating growth rates in China. So China sort of drove the up cycle, which created some misinvestment, and we've been working through the down cycle ever since. I believe we're approaching the end of that cycle, but it's important to understand the driving factor behind the growth, marginal growth in demand, and it is really emerging markets. If you just look at one commodity, copper, 10 years ago China consumed about 10 to 15% of global copper. They're currently consuming between 45 and around 45% of global copper. So you can see where it's and how they've become the important demand driver. Currently, and the reason that the near-term outlook is relatively uncertain is there continues to be questions about China's growth, and very recently there's been some developments within the fixed income markets which are driving some capital flows out of emerging markets, which is negative in the near term. But again, I feel it's important to stress the long term, and when we think of the current monetary policy being implemented in the developed world, it is aggressive, it is experimental, and at some point we feel strongly that when we get into a more global, a stronger global growth environment, we're very, very likely to generate some inflationary pressures, and probably unexpectedly and rapidly. And that's when you probably want to have a commodity investment in an index form, because we could end up with some environments that may not be positive for other asset classes and extremely positive for commodities. And that's a reasonable chance in the next few years. Secondly, I want to talk about one sector that we're particularly excited about, and then I'm going to go on to this particular index and why we think it's important. The one sector that probably had the biggest investment in response to China's demand growth was the industrial metals sector, and we are currently taking the opposite side of that, and we're having the supply response from the industry, and it's been pretty dramatic. Over the last 6 months, the cancellations of CapEx expenditure plans within the mining industry are dramatic. So future mines and current mine expansion has been canceled, and plans have been canceled and cut back globally. And this is important because when we do get back into a stronger global demand cycle, we're likely to generate some very tight markets within the industrial metals, the opposite of what we've got now. Every commodity runs in cycles like this, and I think this is an important thing to understand, and we are setting up the next bull market in commodities with the lack of investment over the last year and a half, and that's pretty broad-based as well. So one of the things that we feel at Van Eck when we looked at having an offering for our firm in the index space, we felt this was a very, very good expression. And to us, there were two very important things. And as Alan mentioned, we felt that the attempt to remove roll risk, both positive and negative, was an extremely attractive part of this product. We also liked the mix, the diversification. We liked the fact that it had a fairly higher exposure in industrial metals than some of the other indexes. And secondly, we felt that the neutral use of collateral, meaning very conservative fixed income investments, was an important item as well, compared to several products out there that are trying to do other things with the collateral. We felt that in the long run, investors were looking for a true exposure to commodities, and we could easily be in an environment where we could have an adverse interest rate environment and credit environment and a positive commodity environment, and the indexes that had exposure to credit and interest rates may actually perform poorly in those environments. So those were the two principal things that we really liked about this index. And so that was important to us. This slide, when you look at the weightings, you can see that base metals have a 26% weighting. On a relative basis, we'll get to another slide that shows it on a pie chart, but it's slightly higher than other indexes. And that was an attractive aspect of the index for us as well. This is a slide just showing the comparative returns. And this really, the roll effect is probably the major thing to point out here. And this is really post-crisis. So this started in Jan '07, this chart. And certainly we could get into an environment where there would be a positive Roland effect. But I think it's important to understand that in commodities, it's very hard, at least in our opinion, to forecast positive or negative roll environments. There's just too many variables within the commodity markets that can shift things dramatically. And we felt taking as much of that risk out, both positive and negative, was a very meaningful approach from our perspective. And then lastly, this just shows the weightings in a pie chart, and you can see the industrial metals weighting is higher than the other two products that we were compared to here. And to us, that was one of the important aspects. And so with that, I would like to turn it over to John, the true designer of these things, and let him go through the reasoning behind it.
Well, thanks, Roland. I appreciate the introduction. I would like to take credit for designing these things. I am able to design products based around a variety of indices, including the UBS Bloomberg CMCI. And as this is going to be part of educational series here, hopefully by the end of my talk, in addition to what our former speakers have brought to the table, you'll really understand the differences between the CMCI index and other commodity indices. And of course, we're open to questions. Any question you may have about commodity index exposure, we could probably answer, so feel free to submit them in the lower right-hand part of your screen. What I really want to get into here is discuss what makes the Bloomberg CMCI significantly different from other indices in general, and that's been touched on before. But I think the key here is that the CMCI is diversified across three different vectors. It's diversified across the sectors and components of commodities. Obviously, there are a broad number of commodity indices out there. The Dow Jones UBS, the GSCI are probably the two largest exposures out there, but there are others as well. The problem with diversification across commodities in a commodity index is that basically there are not many liquid commodity markets that one can get exposure to. You know, at most you might be able to find 30, if you really stretch it, maybe 35 different commodity markets. So it's a limited universe that can be put in an index. You know, it's kind of the diversification of the Dow Jones stock index, where you've got a small number of components. We don't have the opportunity set like the S&P 500, for instance. So the main point in constructing an index is diversification is very important here. Statistically speaking, diversification can be measured, and the CMCI is probably one of the top diversified indexes is measured statistically. I've done the work, but I don't want to get into those details with you. But it is very, very diversified. The other being the Dow Jones UBS is very diversified as well, and they are head and shoulders above other indices out there. The other realm of diversification, and there are two more that the CMCI basically really outpaces other indexes out there, is diversified across the price structure of individual commodity components. And we'll get into this in more detail, but basically for any given commodity out there, there are probably anywhere from 4 to 10 price points along the commodity curve where an individual commodity has risk exposure in the CMCI. Other indices typically have maybe just one price point. They may have 2 or 3 price points, but to the extent that they have other price points out there, they do not go across the term structure for a given commodity to the extent that the CMCI does. The CMCI really has price exposure that goes out to, an average of 3 years for liquid commodities. Thirdly, diversification in terms of rolling the contracts from one to the other in the commodity index. As you're probably aware, with commodity indices, it's not a buy and hold strategy as it would be, for example, with an equity index where IBM, as long as it's in the index, you just own shares of IBM. With respect to commodity indices, and particularly those that own contract exposure near the front, those contracts roll off and mature and have to be replaced with other contracts, and the process of the index maintaining its exposure requires that one futures contract gets rolled to the next. The two primary indices, the GSCI and the Dow Jones UBS, initially have a roll, and still do have a roll period over 5 days. Other indices, as mentioned, may have a roll period over 1 day or maybe 3 days, but in fact, the constant maturity commodity index, by virtue of maintaining these constant maturity points that we'll get into later, in fact rolls the commodity exposure every day. So as futures markets can be volatile and they can have idiosyncrasies, the risk to the index of being exposed to price movements on any given day is minimized by the fact that this rolling process occurs every day that the markets are open. Now, the construction of the CMCI was put together in a very complex fashion, which we'll get into, and the good news is that there won't be a test at the end of the presentation. But the index design has led to several beneficial characteristics. First off, as mentioned, there's really very little exposure to the volatile front futures contract exposure. Okay, and the front contracts are the most volatile typically across the price curve. And that leads to, you can think of the front futures contract as equivalent to the long treasury bond. It's the most volatile of all those in its class. All right, the CMCI, because it's exposed to a lot of futures contracts, but very infrequently does it have exposure to the front contract, in fact, gets commodity price exposure without the volatility. And as we all know, we'd rather get return without volatility. UBS Bloomberg CMCI does that better than most. Secondly, because it does not have exposure to the front contract, the negative roll yield of markets in contango is generally reduced. Now, I'm not saying that there is no negative roll yield in price points further along the curve, but typically it's a lot less. And the roll yield is basically a product of storage costs as markets, which are fully supplied, come into delivery. So by being further out the curve and across the curve with the CMCI, that negative roll yield is definitely reduced to the extent it can be. A couple other factors are pretty useful. The monthly rebalance of the CMCI is, as far as I know, I'm not aware of any other index that rebalances monthly. There may be one other one to its target weights, but definitely the Dow Jones UBS and the GSCI do not do so. So by rebalancing monthly, you reduce the concentration risk. And what exactly does that mean? Well, I'll give you an example. In the natural gas market, for instance, which rallied about 30 to 40% earlier this year, natural gas in the Dow Jones UBS may have started off the year around 10 or 11%, and by rallying 30 or 40% and the rest of the market not doing as much, it's probably up to 13 or 14% of the index as we speak. Now, if that, the natural gas exposure in the CMCI as it rallies would have been sold down to the target weights at the end of every month. And in fact, this rebalancing effect in volatile mean reverting markets, which really describe commodity markets, can add to return over time. It's actually discussed in one of the academic papers. I think there's been several papers on rebalancing return, and the CMCI is one of the leading indices that, in fact, is able to take advantage of this behavior. The daily rolling process is really a risk reduction process. It reduces, as I mentioned, the potential effect of any one day's market action on index return, and not only are prices volatile, but also term structure behavior of commodities is volatile. And if you roll on the wrong day, you can roll on a day, I don't want to say a wrong day, but rolling on certain days may be not the best opportunity. So the rolling process, by spreading it out over time, ensures that you're not going to get caught on the wrong side of a market move, which may exist for any number of a variety of reasons. Also, by, in fact, rolling every day, it reduces the risk of the index activity leaving a footprint in the market. The index is designed so that there can be broad exposure to the index, a large volume, and its rolling activity will not be seen by other markets participants. Fact of the matter is, with Dow Jones and the GSCI, there are orders of magnitude of exposure in that, and every market participant knows when the roll is, and that may not be the best for index investors. But whatever the case may be, the fact that there's a daily rolling process diversifies any kind of risk to commodity investors. Now I'm going to go into the design of the CMCI, and like I say, it's a very complex design index. I'm just going to highlight it, so you're going to see a couple of charts here with a lot of information, and trust me, these slides will all be available, but I just want to give you an idea of what went into the design of this index and point out some highlights. First off, the design of the CMCI is first designed in terms of weights. Sectors are allocated based on economic weights, based on global inflation and GDP data across the major markets, as well as liquidity weights. So sector weights are designed first, and then component weights are basically designed within the sectors. And of course, the sectors are agriculture, industrial metals, precious metals, energy, and livestock. So first the sector weights are designed, and then the component weights are designed. Component weights are basically global production mixed with liquidity weight, which means open interest outstanding and the market value of trading that goes on. By the time this is all done, just to give you an idea of what the index looks like, and I'm not going to point out all these numbers, but the key highlight here is if you look across the top label of the table, you'll see the weights of constant maturities per commodity. So as I mentioned before, there are about up to 5 points in time where the risk for a given commodity has exposure. And for each of those points in time, there are 2 contracts, one contract with maturity ahead of that maturity point and one contract with maturity after that bullet point in time, which are constantly rebalanced. So the risk exposure, for instance, for the 3-month WTI crude contract is a portion of the contract that matures just before 3 months and a portion of the contract that matures just after 3 months. And that is rolled on a daily basis so that the weighted average maturity of those 2 contracts is exactly 3 months. And that is where the name constant maturity commodity index comes from. So in fact, this is done every day, and for the case of where contracts have 5 price points in time, there are in fact 10 contracts that roll around those price points. That gives you the curve diversification that we keep referring to. And I do also want to point out, I mean, we've discussed the the allocation to commodities here. The energy is slightly over 1/3. Industrial metals is about 1/4%. Precious metals are about 6%. Agriculture, less between 1/4 and 1/3, and livestock about 4%. That comes out to be a very attractive weighting for a number of reasons. Number one is that in industrial metals and energy combined, you could consider those to be economically sensitive commodities. So that comes out to about 61%. Compare that to GSCI, which is 70% but primarily energy. That is very concentrated there. In the Dow Jones UBS, that combined weighting is about 51%, which may not give you the inflation protection that you may be looking for. It's a good balanced index. Second thing to point out is precious metals exposure in the CMCI is about 6.1%. In the Dow Jones UBS, gold in itself is about 10%. Now, often in terms of exposure to commodities and gold, some investors like to lump gold in with commodities, and some like to have gold separate as a hedge to as they say, fat tail or event risk. And the CMCI allows one to allocate the gold and not worry about the gold in the index. There is some, but it's not a major driver of the index return. And obviously, gold products are widely available in the marketplace to supplant that or subtract from it as desired. I just want to spend a brief minute and look at performance here and discuss, why, as I mentioned before, that the index has had excellent return, and how the construction has led to that. So what we're going to do here is go through sector by sector for the three main sectors of the indices. Bear with me for a moment. Thank you. So here we're looking at the return for several major indices. We're looking at the agriculture sector, and we're going to show returns here from the beginning of the CMCI, which is the end of January 2007. Look at the agriculture sub-index return. So, albeit these indices may have different exposures to different agriculture components, the fact of the matter is that the UBS Bloomberg CMCI agriculture return has been, over this period of time, which is a little bit more than 6 years, close to 49%. And you can see the other indices, the main indices, Dow Jones UBS and S&P GSCI, returns have been substantially less. I would say that primarily the main driver of the excess return here is due to the term structure effect of the Bloomberg CMCI and the fact that it has index exposure further out the curve. Agriculture commodities typically have fairly high storage costs and have had a high erosion of value because of that. And in fact, because UBS Bloomberg does reduce or even minimize that kind of effect, the returns have been substantially higher. Moving on to energy, although of these 8 indices, CMCI has not been the top performer; it's been second highest performer. Still looking very good. Once again, I think term structure behavior has been the primary driver of that return. Obviously, the Dow Jones UBS stands out on the negative here. I'd say that's primarily due to its high weighting in natural gas, which over this period of time has not been a good performer. Natural gas, as well as term structure behavior in the Dow Jones UBS, has probably been the main contributor to its relatively low performance. And then lastly, to look at industrial metals, which the CMCI, as Roland mentioned, has the higher allocation than typically other indices. Once again, excuse me. Once again, the return has been, albeit it's been negative, it's been higher than any other index listed here, and that once again would be due to term structure exposure. So when you combine these all together and look at index returns, you'll see that since its inception, UBS Bloomberg Constant Maturity Commodity Index has clearly been the better performer of these other indices shown. And that's a combination of not only sector allocation, but term structure allocation across the price curve for the index. And of course, diversified roll risk as well. So, we're happy to entertain any questions at this point, if you'd like. In the meantime, I don't know if we have any Ollie at this point, or we can look at.
Yes, we have plenty. I wanted to thank you, John, and Alan, and Roland. We definitely have time for questions. And again, I want to remind all the audience members that if you would like to ask a question, please enter them at the lower right of your screen, and we'll put them right in the queue. On that note, let me dive right in. Now, let me take a step back here. You're talking about a number of products, or I should say a number of product wrappers, so the open-end mutual fund, and the ETN, and it so happens that the biggest exchange-traded products canvassing this space are ETFs. And I'm wondering if maybe, John, you take a crack at the ETN, and maybe, Roland, you can talk about mutual funds, but are investors missing anything crucial here in the ETN wrapper relative to the ETF? And we can get to the mutual fund in a moment, Roland, but John, why don't you take it first?
Well, in terms of the ETN, as you know, as professional investors are aware, ETN is a note issued by UBS. It passes through the return of the index. Of course, there are fees involved. There may be some beneficial tax effects by virtue of owning a note. You could own it for a long term. That may affect your tax position. You know, being a note of UBS, it is of course subject to UBS credit risk, which I'd like to point out is incredibly good, one of the top out there. You know, in the bank universe. So, you know, there are a lot of, I think, benefits. I think primarily, you know, potentially tax effects in there. You know, that makes a note an attractive investment.
Okay. All right. Thank you. Another question, taking a step back, let's talk about the credit risk concerns. You just shed light on UBS. I presume you were suggesting it's a relatively healthy institution. How do you handle that? Certainly, in the wake of the credit crisis, a lot of people have just definitely steered clear of ETNs because of this. So, how do you address that when an investor comes and says, you know, I don't know about this credit risk issue?
Well, I can't, you know, I can't decide their credit risk, you know, allocation, but believe me, we issue a fair number of notes, not only in the ETN program, but in other markets as well. And I know that institutional investors, when they look at notes, they look at credit ratings and trend in credit ratings. And like I say, you know, we've all obviously been in the financial markets during the crisis, but, you know, our firm, if you look at credit ratings and past trends and current position, you'll find that it's, you know, probably top 3 out there.
Okay.
All I can do is present the facts and let people make their informed decisions.
Right. Roland, Wait, I would just add one more thing. When you think of the commodity futures products, that I believe in the exchange-cleared mechanism, and I think there's, you know, an underlying safety through the exchange mechanism. So I would just add that as a you know, as a comforting factor for investors that are investing in the commodity space.
And when you talk about the exchange cleared, that essentially applies to all 3 wrappers here, whether we're talking about a mutual fund, an ETF, or an ETN. Is that correct?
Well, to some extent. It's just that the underlying, when you think about the underlying risk that UBS is exposed to, and ultimately, I guess, the investor, it's really an exchange-cleared mechanism, which I think investors should have a lot of faith in.
Got it. Here's a question from the audience. With all these trading costs, the different placement and owning different contracts on the curve and different commodities, it looks at first blush as there would be more trading costs involved with this sort of a diversified process that is in the CMCI. I presume this is a question for you, John. Please address those trading costs.
Sure. Well, you know, since we do obviously take into account our costs when we sell the risk to institutional investors or whatever product it is, we have a very good handle, and you know, with our large book, we have a very good handle on trading friction and the costs associated with that. Remarkably so, not that I'm going to get into our costs in general, but over the years, liquidity has moved out the curve in the commodity markets. So pretty much for a significant part of the commodity curve, there is not that much of a transactional friction, you know, in the immediately further out the curve than there would be in front futures contracts. It is a little higher, but I would be surprised if, you know, on the order of 10 basis points over the course of the year might be, you know, the order of magnitude the additional cost of getting this, full curve risk exposure as opposed to just front month, and that in fact, is dwarfed by the excess performance.
Okay, I'm sure we're going to get more into the very finer points of this. Roland, I wanted to bring you back into the discussion for a moment. You had talked about the importance of an indexed approach at a time of transition in the global economy and inflationary pressures coming from corners that aren't always predictable. Now, you said indexing is arguably superior in this kind of environment. Now, I've heard the very same case made in favor of active investing, and I'm wondering if you might help unpack that a little bit and shed more light on the argument you were beginning to make there.
Well, I was simply, to be honest with you, making the point about this particular product and why Van Eck's been in the commodity space since the 1960s when we launched our equity-based gold funds. And then in the early 90s when we launched our hard assets natural resource equity investment products. And when we looked at the actual commodity space, as I mentioned earlier, we felt this index in particular was attractive, but we wanted to have an offering that was a broad-based index like this because we do feel that there is the chance that we are going to get into an unpredictable inflationary environment. And there's reasons to own gold, there's reasons to own equities, but there's going to be times when there's reasons to own commodity indexes. And we felt this was an offering that made sense and fit well with what we do as a firm and our history. So that was, that's kind of our view of this product and the indexing concept as a whole.
And Ollie, I would just like to add to that, and I don't want to emphasize that Van Eck Global is probably, if not the largest, one of the largest pure commodity-related investors, and they're also equity investors, which means they're very forward-looking. And back 3 or so years ago, when they made this decision, they could have done this with any index out there that they wanted, and I'm pretty sure that they looked at all of them. So it wasn't, let's just grab one and put it on the shelf type of thing. These guys are very thoughtful guys, and they thought long and hard about what they wanted to do to represent, this sole product for their firm, and they chose CMCI.
Yeah.
It wasn't. Let's put one on the shelf because everybody has one too.
Well, that certainly sounds like a possibly convincing pitch for CMCI. I'm wondering if you're confronted with that question to an investor and advisor who really needs to be informed a bit more carefully. What's the easy way to really capture that fact, the argument you're making?
Well, in the industry, what's recommended and what's put forth, there are a lot of people that put forth their opinion. I do want to point out that CMCI is widely distributed globally, and so global investors who may get different sets of input than U.S. investors have chosen CMCI, and as you mentioned, close to $10 billion of exposure has been distributed in this index. In the U.S., not as much. But just to give you a little anecdote, I was talking to a wealth manager that had about $10 billion in assets under management, and I asked him what he had. He says, well, we have a Dow Jones UBS-based product that we expect will outperform the index by 75 basis points. He said, me personally, in my retirement account, I have the Van Eck Fund. So, it's a matter of, what fits your benchmark. But if you're really looking for return, and this is a guy who clearly was putting his money where his mouth was, he had done his research in commodities, and he put his money into CMCI for his own money for commodities. Okay.
Now, the returns that you talked about, John, certainly relative to some of the other indexes that you had up on the chart, certainly relatively strong performance even when you were in the red. And it would appear that both because the energy and the metal sectors had negative returns, that you obviously had very positive returns in agriculture and livestock. And I'm wondering if you might unpack that a little bit, that significant outperformance that the chart showed on the ag front.
Well, the ag front, as I mentioned, is really where a lot of erosion of value has occurred due to front month exposure. And you have to look at commodities. When you look at commodities, when you get to front month exposure, what you really have is commodities plus storage. And further out the curve, since the supply-demand situation isn't really known out into the future, that's why you have a flatter term structure, and that's why there's less of erosion of value from rolling down the price curve. And that's where the CMCI gets a really much more exposure than most other indices. So, like I say, agriculture markets is where this erosion of value has been really significant. In other markets, WTI crude oil and natural gas have been really significant. A little less so in the metals, but still there to a certain amount. And we really avoid that. When you look at owning, if you look at owning assets or owning commodities, if you own them further out the curve, you're basically owning production in the future, and you're owning longer-term price exposure, which really where inflation comes in and supply-demand imbalances come in. That's where you'll get more stable price appreciation.
Got it. Now, Roland, I think you may have begun to sort of get at the answer to the question I'm about to ask. Maybe you want to take this one. You were talking about gold and how you might want to augment a position as it exists within the CMCI, but why not include higher weighting in precious metals in the CMCI to protect against currency debasement? There's certainly a fair amount of concern about that coursing through the global economy at this time. So why not have that right at the heart of the index methodology?
Well, I mean, we offer both types of products in the equity space, and there are very easy ways to invest in gold now. And to be honest with you, we view the ownership of gold as a currency alternative, and we view it as a different investment than the actual broad commodity space. The broad commodity index is going to do very well when we generate stronger global growth, and at the same time, with the active monetary policy in place, we bring forward inflationary expectations. Gold is going to do well in a number of environments. If we got into a hyperinflation environment where currencies were really collapsing, gold could become the global safety asset again. It's been out of favor for the last 2 years roughly, but those are the type, John mentioned tail risk. Those are the type of reasons that you want to own gold. It may indeed be an environment where both gold and commodities do well, but there is a much broader set of possible outcomes with the current, what I would call experimental monetary policy being employed. So there's probably only one or two where they would both go up. So we really feel that an investor maybe ought to own both. And that's, again, another reason that we liked this index. We felt it really offered the direct exposure to the actual commodities bet. And we have felt historically that the two bets are different.
And I'd just like to toss in a few words there. I'd like to toss in a few words there. I've come from an asset management background. I've talked to a lot of institutional investors. It is not surprising that institutional pension fund investors have differentiate their gold exposure from their commodities exposure. They are really used for two different things in the institutional market. And to point out when the Dow Jones AIG, now the Dow Jones UBS Commodity Index, was developed back in the early 90s. If you look at the construction methodology, it was designed to hold a little bit more gold, than it otherwise might have, depending on the design methodology. And at that point in time, it was probably more difficult to get gold exposure. Nowadays, with the advent and development of all sorts of exchange-traded products, it's very easy to get access to the price of gold separately. That's a completely different market timing situation. If you look at the exposure to gold and exchange-traded products recently, it has dropped dramatically. Whereas for commodities in general, broad-based commodity indices, we haven't seen really anything that I would say is a noticeable downdraft in risk exposure. but it's public knowledge that gold exchange traded product exposure has dropped dramatically. Just emphasizing how uncorrelated that risk exposure is and how it means different things to different investors.
Got it. Now, a performance question here that came in from the audience. It appears that CMCI does rather well against the first generation indices, DJ, UBS, GSCI, which the questioner notes isn't hard to do, but suggests that it's not performing as well versus other indexes, second generation ones that do not use constant maturity, but rather systematic roll optimization. I wonder if you could talk about that a bit more in a bit more detail, and if there's any repetition going on here, I apologize. There's certainly a lot of questions that are sort of demanding more further elucidation. So again,
well, no, I think that's a very valid question here, and I just put up a slide that we have, which was not shown as part of the presentation, but the CMCI versus some second-generation indices. I think it still shows that, and I do agree. One of the attributes of the main indices that make them attractive to asset managers is that it's fairly easy to show outperformance because there are a lot of strategies which historically have outperformed and may continue to do so in the future. But here you have on this slide, you're showing the performance of the UBS Bloomberg CMCI against several other second-generation indices. And I would say, in terms of both absolute return and risk-adjusted return, it's showing up as, over this time frame, which includes some 10 years worth of information, it shows very attractive performance levels. So, most of this time is pretty darn good.
Right. Now, here's some very granular questions. So let's get under the hood here. The daily rolling.
I just do want to point out that I apologize if the color coding is wrong. That the blue line on the top of this graph is in fact the CMCI and is not coded properly. I apologize for that.
Okay. Yeah.
But the numbers, the numbers are the performance numbers are the ones that are relevant.
CMCI is the highest line there on that graph, is what you're saying.
Right.
Okay. Again, I was just starting to say that here's a very detailed question. Time to get really under the hood. There's a question about the daily rolling process.
Right.
How that works, and this audience member would like a further explanation about how that works, the mechanism of it.
Sure. We'll take for a hypothetical example. We'll take the 3-month point of risk exposure for WTI crude. All right, and for 3-month risk exposure, we are going to have risk exposure on a dollar-weighted basis that averages exactly 3 months every day. Now, in order to get that risk exposure, there are 2 contracts for WTI crude, one that matures after 3 months typically, and one that matures before 3 months. So what is done is every day we take the weighted average price of those contracts times the risk exposure to make sure that the notional risk exposure times 3 months exactly equals the dollar-weighted average price of both of those contracts. Now, for further out the curve, where there may be more contracts in WTI, every month, but at the 3-year point in time, we go to the liquid contracts, which may be in fact the December and June contracts as you move further out the curve. Still, weighted average notional value of 3 years, but we do want to stick with the liquid contracts around there to ensure that we're not, that we have enough liquidity to get index exposure and to reduce transactional friction.
I would also add the beauty of doing this on a daily basis is you're rolling very small percents of the position, which gives you better liquidity profile. So that the market really can handle this, and when you spread it out, on a daily basis, it just improves that characteristic.
Okay. Now,
good point.
Go ahead. There are some broader questions here. This is clearly a space that is still gathering interest among investors and advisors, and these questions are a little bit more focused on the abstract. Here's one: what is the right balance between capturing moves in spot prices and optimizing the shape of the futures curve?
Well, I mean, the conventional wisdom and the easy answer is to say, the movement in prices across the curve are all highly correlated, and that's a bit of a cop-out, but I'll at least bring it out there because you will hear that, and generally it's true, but that's not telling you, that's not the question you want to ask. You really want to know is how much of the potential price movement can you actually get hold of? And then you may want to look at it in terms of, is there some dynamic algorithm that allows me to capture more of it than I would by a general, more or less buy and hold strategy? And in some markets, over time in the past, an algorithm has outperformed, and that is basically, you can look at that as option writing to a certain degree. But believe me, if we saw a product where an algorithm worked particularly better than others all the time to a significant degree than what's in the CMCI, we would, certainly develop a product around it. But oftentimes it's better just to avoid the most risky and historically less attractive returning part of a curve. For instance, to do the bond market analogy, you're much rather off owning 10-year notes than treasury bonds. You'll get almost as much yield with probably, 50% or even a third of the volatility. If you need the risk of the 30-year, then maybe you could lever up with futures or something like that in the bond market. But to the extent of owning the front contracts, you are in the risky part of the curve, and you do pay a price for being there.
Right. Now, some of these questions might be force you to repeat yourself, but I think it's emblematic of how people really want to understand this better. Taking a step back, how do you determine the weight of each commodity? What parameters? Production? You've mentioned liquidity, certainly. If you can shed some further light on that, that would be great.
Well, that is a really complex topic. This chart I have up here gives you an overview of what the weights are per sector and what the weights are per component within those sectors. I do want to point out that, and as part of the presentation, and probably as part of the material sent around to participants, there will be a link to the UBS CMCI website where the methodology is available for public consumption. It's a large, complex document. But basically, we look here at economic significance as well as what the market trades in terms of open interest and trading volume, and combine those for sectors. And then for weights, it's basically consumption, which generally equals production over time, as well, once again, with liquidity exposure. And the results, the index is rebalanced twice a year. New weights are developed every year and implemented at the end of January and July. But if you want to get into more detail in this, as opposed to me trying to explain it verbally and getting it wrong, like I say, you will have access to the UBS website with the document that describes it in very detail. And I will advise you, it is a very complex series of formulas and data collection that we maintain to do that. But it is there in all its glory.
Okay. Well, that I figured your answer might get us deeper and deeper into the subject, but certainly the curiosity is there. That's about all the time we have. That concludes our Expert Series webinar on a better way to get commodity market exposure. Alan, Roland, and John, I want to thank you for being my guests. And I also want to thank the audience for attending and for coming up with some thoughtful questions. Also, I want to remind the audience that a copy of the slides will be available to you 24 to 48 hours after today's webinar. On that note, on behalf of all my guests from Bloomberg, Van Eck Global, and UBS, as well as all my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.
Thanks, Ollie. Appreciate it. Take care.